Mr. Godwin Emefiele there. Now, joining me live in our Lagos studio to give a deep insight and, of course, perspective into this. He's the Chief Investment Officer of AfriInvest Assets Management Limited, Mr. Robert Omotunde. Mr. Robert, it's very nice to have you on the show. Thank you very much for your time.
Thank you for having me. Always my pleasure.
I can imagine Lagos traffic and all of that, so it's really, I appreciate your time. What strikes me in what the CBN governor said, I was there live and I listened word for word, is the fact that he says it's possible we exit recession in the first quarter of 2021. The Minister of Finance has also said this. It looks to me like a tall order. How possible is this with all that we have on ground?
Well, I think there are two things to dissect. So there's the desirable, and then there's the reality. The desirable is that we would even expect that by the time fourth quarter GDP comes out, we exit the current recession. But the reality on ground is there's so many pressure that most households have to deal with. And, I mean, the central bank governor alluded to it. The household still constitutes a larger chunk of our gross domestic product because we talk about private consumption expenditure as a significant part of our GDP. Now, in that private consumption expenditure is food, which is also significant. I think food accounts for over 50% of private consumption expenditure. And the greatest pressure we've seen in this current recession that we are facing is the huge impact the household have to deal with in terms of food prices, which I would say we've brought upon ourselves, because of some policies of government that may not have really favored the household. Think about it. The household has been beaten on all sides. We had the border closure in 2019. That border closure has, the major staple food that Nigerians eat, rice is one of them. Rice, fish, I think two other commodities are the major staple, and they constitute a huge chunk of, imports into the country. But we've actually shut the borders, and today you have to pay for rice more than ×2 of the price, even if you have to import it, as at today. And I do a quick analysis. To buy a metric ton of rice, if you're importing, it's about $362 per metric ton. And in that metric ton, you will have about 1,000 kg. Now, a 50 kg bag of rice today is selling for over 30,000 naira. But I say that even if you have to import rice into the country today, and you assume exchange rate of 490, and you put 70% tariff and another 30% margin, you will have bought rice at 23,000 per bag. But now we are paying over 30,000 for it. Now think about it. The economics was not just right for the for the closing of the border. Sure. Now we're talking about reopening the border. But the damage has already been done, right? An average household has not had improvement in their wallet, in their consumer wallet. But VAT increase, which was justified because government needed to raise more revenue. Closure of border, increase in electricity tariff, increase in, pump price of petrol. These were all things that we advocated for to get government going so that government can have and free up revenues for, critical infrastructure. But the way they have come and some of the things we've brought upon us. Now, imagine that we didn't have to shut that border when we did, And of course, we can dissect some other monetary policy issues that may have brought us to where we are today. Exchange rate is a critical one. Today,
exactly. The central bank is even, making it. We'll get to that. But I quickly want to chip this in that someone saying, vaccine development looks like everything is looking better. Restrictions might be limited. People might get to work and all of that. What effects do you really see? Because we also see Asian markets and all of that reacting to all of this, and even the presidential election in the United States. So how do you see all of this also shaping up what we'll see in this part of the world?
I think that it's a good thing that we are beginning to see development of vaccines. One thing is to get, success in developing vaccines. The other is for people to get vaccinated.
Vaccine availability.
You know, so if you don't get vaccinated, you know, just the success we realize from getting the vaccine is not sufficient. You know, and I think that's where the crux of the issue is from now going into 2021. But of course, like you said, market has been reacting. If you look at the equities market globally, they've been very positive. You know, oil prices have rallied close to, you know, $49, and is now gradually retreating. You know, we've seen developments that are, you know, majorly positive across the global economy, all because of all of the successes that have been reported from, you know, vaccines. And of course, if it should happen, we will also benefit, because what it means is that if there's recovery in, you know, global oil prices, it tends to benefit us, because as it is right now, it's still one commodity that we've, you know, technically built our lives around, such that once there is any shock, any major shock in the international market, then we'll begin to feel the impact domestically. But I think the point for the government is that we need to, you know, continue on the path of diversifying away from oil, because that's the only way we can, you know, get out of the, you know, these global vulnerabilities.
No. Back to that report, that speech at the bankers' meeting. The central bank came out clear to talk about their support. Car COVID is one of it, which we all know what even happened eventually. Strengthening loan-to-deposit ratio, survival funds by the federal government. Also, you know, a lot of this expansion, even in the manufacturing sector, we've seen that too in all of these figures. Well, what will you say about the impact of all of this? Because that's what it really means to me. To GDP, the central bank government said about 3.5% to the entire GDP. What does this look like? A drop of water in an ocean? Well,
I think that, and with all fairness to the government and the central bank, what they're trying to do is to, if you like, stimulate the economy.
Yeah.
So all over the world, when there are challenges like this, governments, you know, authorities try to put in policies to stimulate economic activities. But I won't say what they are doing is sufficient. And again, not because if they have the opportunity to do more, they won't do. But the capacity, you know, I mean, for an economy that is this huge, you know, for how long can all of the, you know, funding from the central bank, you know, for how long can it sustain an economy of this nature? So the point we are saying here is that government is making efforts, which is good. But sometimes, you know, just putting the right policies in place can even save the government the stress, you know, of having to create funding this, funding that. Today, central bank has been trying to get the banks to lend to the private sector. And even if you check the, you know, credit to private sector data, we see improvements. But let's be honest with ourselves. The real private sector that needs to drive this economy are not necessarily getting the funding that you're seeing in the growth of credit to private sector. And let's be honest, you know, in an economy that we are today, if you aggregate about 100 multinationals, the prime borrowers, you know, I can tell you that 100 of them may possibly account for over 50% of the credit to the private sector, you know, in this same economy. And then we're talking about the informal sector. Do not forget, most of the banks can't find it even convenient to loan money to the private sector. The reason is because maybe these businesses are still struggling. There are a lot of risk inherent in them. And that's why today, you're talking about yields that are below 1%, you know, from treasury yields, you know, below 1%. And then you look at prime lending rate at about 11%. And maximum lending rate is still staying at 30% or 28%. What's the problem? You know, because there is a lot of risk within the system. So commercial banks find it much more convenient and profitable to give money to the prime borrowers at 11% than give it to the, you know, to the informal sector at 28%. See the margin, more than, you know, close to 20% spread in terms of margin. But they won't do it because of the inherent risk. So sometimes to catalyze this economy, you know, there is no doubt about it, we need to grow our credit system. But while won't the banks find it convenient to lend to this sector that accounts for over 53% of our GDP? Now, that is where the role of government comes in. So rather than create funding this, funding that, why don't you work towards de-risking this, the overall business environment, so that these banks, on their own, at their own volition, can decide to lend money to these critical sectors we're trying to support. After all, these guys are in business to make money. So if there's opportunity, government will not tell them before they go in there.
And when they
you understand?
They'll definitely pay tax to the government.
So it's about getting it right. So funding this, funding that. At the end of the day, some of those funding, how they are deployed may not even be through, an efficient means. And then how many funding can the central bank create? Do you know how many support systems that we have from the central bank, into agriculture and borrowers program, manufacturing, airline, power, pharmaceutical. Now we have youth funding. How many of those? At the end of the day, the capacity, and let's be honest with ourselves, if we have the opportunity to look at the balance sheet of the central bank, now we've not seen it in a long while, the central bank is probably overstretched in terms of all of this funding and intervention. So we shouldn't get to the point where we overstretch the central bank and then the central bank, nobody's even asking where are the sources of this funding. And I bet to say that some of them are printed money that are used to intervene, and at the end of the day, they find their way back into inflation, which we are already complaining about today. So it's a lot of issues, but I think sometimes just putting the right policies in place can just help us address some of these problems.
Policy issues.
Yeah.
Now, I still want to stay with the banking industry, because Nigerians like to know what the true state of the banking industry. The CBN governor says banks remain very strong, stable. That's what he says. He even said capital adequacy ratio for the banking industry at the moment is above 15%.
Absolutely.
How does this come to you?
Well, the banks will remain strong because of the stringent regulations that the central bank is putting in place.
Yeah.
Right? So globally, the threshold for capital adequacy ratio is 8%. Right? But in Nigeria, the central bank has a much more stringent prudential guideline for capital adequacy ratio. Some banks are expected to maintain 10% if you're a national bank. If you're an international bank or you're a systemically important bank, you're expected to maintain 15% or 16%. So if you look at it, and from the, from what the central bank governor mentioned, you have above 15% capital adequacy ratio, which means that we are not about to have a banking crisis upon us. But what can cause that banking crisis to happen is if the banks are continually being forced to lend to the risky sector of the economy. And then when they lend to the risky sector of the economy, it comes with what we call NPL, non-performing loans. If those non-performing loans become so huge, we are seeing them in the double digit, it's a matter of time, then we'll start seeing, banks that will start collapsing. In 2016, we saw that, that was a major issue at the fall of the global oil prices. But in 2020, now that we are seeing another recession, that is not, it's not the same issue, because some of those loans have been kind of restructured and then we now have them, performing. But we should tread carefully so that by the time we force those banks to now start lending to the risky sector, we don't get to the level where NPL for the industry starts hitting 20%. That would not be good for the economy. As it is now, Nigerian banks are very strong.
Good. That's good to note. Let's now look at the FX. You mentioned FX issues, and we see all of the efforts even by the same central bank telling us that our reserves remain stable. We can import for 6 months, I think. It says there's no problem. And as of today, CBN grants unfettered access to Forex from diaspora remittances. Now, what do you make of all of these efforts, and what's your outlook for the Nigerian economy? What are you looking at? 2021, some say, as bad as 2020 looks, well, we could possibly get out of this. With right policies, I agree with you.
Yeah, I think that, so many things hinge on the foreign exchange policy.
True.
Again, because this is an economy that is largely import dependent. And to that extent, we need to, have appropriate foreign exchange policy in place. During the meeting, the central bank warned that people should not patronize the legal market, the parallel market, And sometimes it's amazing to know that the economy may have even been sustained by the activities going on in that market, because for some products that government doesn't, central bank does not give foreign exchange to, some of them source from this alternative market, and they are still able to, import those things, since some of them are not officially banned from the fiscal authority. Now, that said, the issue around foreign exchange borders on a lot of factors. And today we have different sources of foreign exchange into the country. One is oil that we over-concentrate on. Now, today, if you have to look at inflows, into our reserves from oil, maybe oil will account for barely about 20%. Remittances is a major one. Foreign portfolio investment of flows and foreign direct investment are another sources. But FPI has been significantly hit, since this pandemic started. By Q2, we saw that significant drop in FPI. We barely made 500 million in FPI inflow. And that trend continues, because of, also our interest rate environment, which is not favorable. Now, the alternative is for remittances, which is why the policy announced yesterday by the central bank is apt. You have a situation where remittances find it more attractive to exchange at the alternative markets, let's not say parallel markets, since it's been termed illegal, the alternative market to the I&E or the official windows. Now, and that said, if you look at the spread that you find there, from now it's trading at 490, 480. From 480 to 390, that is now at the official window. That's almost 100 naira spread. So it's a no-brainer that anybody who has foreign exchange will prefer to exchange at those alternative markets than come to the official market. So what the central bank has now done is to say, even if you exchange through the official, bring it through the official system, you can still get your dollars out and, exchange it at those alternative markets. So it's a game of pretense sometimes when the central bank says, the official, the parallel market is illegal. It's not like the central bank itself doesn't know that that market sometimes even supports some of the activities going on, at the official window. But I think the reality on us is that, this time around, the central bank has done better than we had in 2016. This is about the third adjustment we have seen since COVID-19 started. And if we see necessary adjustment as at when due, so that it creates that balance between demand and supply, then we are able to, track what our exchange rate should be. But in terms of outlook, I must say that it's very dicey. It depends on what the central bank does with its foreign exchange policy, since so many things are hinged on it. If we're going to come out of this recession by first quarter, let's not get too excited. So even if we come out and the economy grows by anything less than 10%, let's take it that we are still in a recession. Because don't forget, in first quarter, the economy dipped by 6.1. In second quarter, it dipped by 3.6. So what that means is that for us to really get out and be restored to pre-COVID, the economy has to grow at least by 10%. That's when we get to pre-COVID. And to now get to the pre-2014 level, we need to be growing at 20%. So it's a lot, and I think the government needs to appreciate the fact that the Nigerian, household has come through a lot of pressure. Without wages increasing, people have had to, pay a lot. You were buying a bag of rice 3-4 years ago for less than 10,000, and today you have to pay over 30,000 to buy a bag of rice. How can an average household cope with that kind of situation? Maybe that is why the central bank keeps coming up with, intervention programs, and government keeps coming up with palliatives. But like I said, if the policies are right, maybe the government will not have to stress itself about palliatives, because those policies will just get the economy moving.
Naturally.
Naturally. Yeah.
I must thank you. I know we can go on and on. I see that passionate we're talking about Nigerian economy and all of that. I must thank you, Chief Investment Officer of Afri Invest Assets Management Limited, Mr. Robert Omotunde. Thank you for spending your afternoon with us on Business Nigeria.
Thank you.
Thank you very much.